right, there we go. We're live. I've got a couple hundred of videos out. I'm a celebrity. You watched a bunch of them. They're really boring. And somebody says, well, do you keep people from other schools from watching those? And I'm like, who would watch those? Anybody out there that wants to pull those things up and watch them is free too. Dan Bauer was kind of the finance professor. Anyway, Dan and his wife looked at one of them. So I lost in 5 minutes. It was kind of funny, but yeah, so I don't know anybody learns anything from you. I don't either. Anyway, all right. I was talking about relevance and faithful representation last time, wasn't I? Yes. We were over on maybe page 51, maybe in there. What's on page 46 is really critically important, that chart. In fact, maybe we'll start with 46 and then we'll go over to 51. Okay? Read everything carefully. Stuff that's inside it, stuff that is highlighted, obviously you want to know all that. Anything that's highlighted. I told everybody in these 2 chapters, anything's fair game. Okay? Was anybody else not here last time? Only one slacker. Okay, good. For instance, if I said, give me a definition for liability, you could, right? Not word for word, but all the keywords. Okay? Definition for assets. I can do that one. Liability, I have to think about it a little. Probable future economic benefit obtained and controlled by an entity as a result of past transactions is an asset. Right. Okay, got it? If I actually compare and contrast relevance to it used to be for liability. Relevance and faithful representation, could you do that? You determine with the 3 parts of each part with a short essay, right? Okay, that kind of thing. Anything's fair game. The quiz could be, somebody asked me to see it. It could be all short answer essays. Probably won't be real long answer essays, but I could ask you an essay of how the FASB works, right? I could ask you an essay on what are the 3 organizations that have created generally accepted accounting principles over the years, and approximately when were they functioning and what did they do, right? And who are we talking about? CAP, APB, and FASB, right? And I could ask you, you say this yet? How do you formulate a FASB? What's the process? So page shows that chart. A FASB, which is GAAP. Yeah. Who's got the right to prepare generally accepted accounting principles? Who's got the right to issue them? SEC. Who typically does it? Because the SEC is not well funded and they are FASB. Right? You can answer this stuff, right? Okay. Public Company Accounting Oversight Board relates to what? Generally accepted auditing standards. For what kind of companies? Publicly traded, publicly held. Across the federal level, right? Across state lines. Right? Okay, SEC Act applies to them too, right? Within a state of blue sky laws. So if it's a private company though, then they just follow generally accepted auditing standards, SASs. Okay? Public Company Accounting Oversight Board, their standards are for public companies, right? For big publicly traded companies. That's a big deal. You could do this, couldn't you? No, everything that's in the chapter, but I'm not going to expect you to recite word for word. But no, everything that's in these 2 chapters. And this may seem silly, but Deck's going to want you to know it in the next class, in 212. He's going to quiz you again in chapter 1 and 2. Right? And have it on the test too. And guess what? On the CPA exam, they're going to expect you to know it. Oh, I said it could be short essays. Could be maybe a longer essay, like how does the FASB work? Maybe a little longer. I don't want to read a book. So, yeah. Anyway. And then it could be multiple gaps. It could even be filled. Right? What is this? I'll give a definition, you can get a word. Yeah, and that kind of stuff on these 2 chapters. It's really hard to give a quiz on this stuff. I like this for French better too. But it's important to know this. It's really critically important, and we're going to use it. Okay? Know what the conceptual framework is, right? And I pointed out in the conceptual framework, what was it? There are 8 of them, and only the last 3 or 4 are effective. The rest of all them superseded, right? So know what's basically in and how that system works. Okay? All right. So let's look at page 46. Okay. Oh, by the way, you guys, also in both chapters, they said the definition of the objective of financial reporting. Didn't they do that in both chapters?
Yes.
I can't find it in the second chapter.
Well, I know they did like first page first.
Right. Towards the beginning. Okay, what is it anyway? We go back to it.
Provide financial information about a reporting entity to potential and present investors and creditors.
Sounds pretty good, right? About, it's really about cash flows. You know, to calculate the present value of anything, which is how we value anything. That's what you have to do. You got to get the discounted present value. What do you need to know? Future cash flows. We use financial statements to guess future cash flows. Estimate what they're going to be. And we also use them to evaluate the riskiness so we know what the discount rate should be. And by the way, when we do WACC CAPM in here, we average cost of capital, capital asset pricing model, in a few weeks, when we do that, we are going to actually try. We're going to come up with our own estimate of the value of the company. It's really fun. The finance types in here are going to love it, right? Really good. And if you, I asked if anybody was in BA or Finance 315 right now. Some of you are, right? You know, they get it in there too. So when you get to Finance 315, you're going to do it again there. If you do the MBA program, you're going to do it again there. This is really important stuff, okay? But anyway, what do we do using these statements for? Predict future cash flows and estimate the riskiness of the company so that we can come up with a discount rate. And then we can value the company. So think about it in these terms. You want to know about resources, right? That's cash in, cash out, ultimately, right? So it's about resources. So your definition is good. I like it. Okay, so could you write down the objective of financial reporting for me? I bet you need more questions there. I bet you need the hours of it there. You're welcome. Okay, all right, anyway. Primary users, capital providers, investors, and creditors, but other people too, of course. Okay? What's the overriding constraint that we got? Cost. Never do anything where the cost exceeds the benefit on purpose. Do we sometimes do that?
Yeah.
Well, yeah, people lose money, companies, right? The cost exceeded the benefit, exceeded the revenues. But you don't do it on purpose. So you constantly think about, is the cost of collecting this information more than the benefit that will be derived from this information? We don't just do stuff to do it, right? Okay. So the best accountants are people who have extremely high integrity. For auditors, it's really true. Extremely high integrity, so they do everything they need to do, and they are extremely lazy, so they do nothing they don't need to do. And you're always walking that tightrope. It is unethical to do work for a client and charge them for it that you did not need to do. Stole the fee. You want to do extra work? Fine. Don't bill them. Right? I wouldn't. Right? So we're constantly balancing this. But it's also unethical to do less than you need to do, right? So it's sort of the game here right from the beginning, cost benefit. Decision usefulness is the pervasive criterion. If I say, what's the pervasive criterion? And there's a blank, what are you going to say? Decision usefulness. Of course that's the overriding criterion. What's the deal with that? I want to give people information that they can make decisions with. If it's not valuable for making a decision, it's probably immaterial. Right?
Yeah.
Who cares? Don't give it to them. Right? They don't care. I don't either. Right? If it's useful for making a decision, then great, we're going for it. If it's not, then why would we just close that? Okay? All right, so decision usefulness. And then the fundamental qualities are relevance and faithful representation. What did we say? And we can flip over to page 51 here. Yeah. Page 50, I guess it's the same thing, except for that's where they talked about it a little bit. What's the deal on relevance and faithful representation? A relevant friend is one that a relevant boyfriend or girlfriend?
Very important.
A relevant significant other. What do you think? Very important. It matters. They matter to you, right? Relevant information makes a difference in making a decision, right? Okay. Faithful representation. We used to call it reliability. I kind of like that better. It's reliable. You can count on it. But faithful representation is it faithfully represents what we're trying to report, right? Which is fine. Okay. Faithful representation. So you think you change it? Yeah. So, okay. Faithful representation. What's the deal? A faithful friend? You can trust him, you can count him, right? Okay, now, if you know that, then you could write that down, right? Don't tell me about your friends. Tell me, okay? Tell me what they say it is. But, you know, if you think about that, look at the things underneath relevance. Predictive value. You know what? I love information where I can predict the future with it. What about you? Predict those future cash flows? Yeah, it's real relevant. Confirmatory value, what's that? We did projections of what we were going to do, a budget of what we were going to do, and now we're comparing what actually happened to the budget and analyzing why we did better or worse or whatever, right? How we can improve in the future. information, isn't it? Okay, oh, that decision usefulness, there you go. So that's relevant, my decision making. And then what about materiality? We just said it's not useful if it's immaterial, right? So that's how they get, I guess, that's how they get materiality. But anyway, that's how they get it. Okay? So what three things would you, if I asked for a definition of relevance, what would you say?
Materiality, confirmatory value.
It's something that, it's information that is useful in making decisions, right? So and it's going to be helpful in making decisions, you can say it that way. And it has three components, what?
Confirmatory value, predictable value, and
Materiality. Give me those things, you got it. Okay, same on the CPA exam. You did an essay on this stuff on the CPA exam? Just tell them. Big deal. Ah, you know what? Your competition won't have a clue what they're asking. You pass, they don't. Got it? Our students pass. Right? That's because you know it. Okay? So get yourself, you're a student, right? Get yourself so you know this. I mean, really know it. Doing great. Okay? And besides, isn't it common sense? Once you know it, it's common sense, right? Okay, get to that point. Okay, faithful representation. Completeness, if everything's not there that matters, I don't know why materiality doesn't go in there too, right? Yeah, but anyway, if everything's not there, then it's not a faithful representation of what's going on. It's got to be complete. Neutral, it's not biased. It's unbiased, right? Neutrality, or unbiased. If you made an estimate and he made an estimate, right? If they're unbiased estimates, they'll be pretty close together, right? But if he works for the company and you're an outside independent auditor, they might not be very close, huh? Because he's biased if he's working inside the company. Got the idea? Which is why we have outside independent auditors. Make sense? Okay. Anyway, so yeah, neutrality and free from error. Obviously, if it's mistakes, then it doesn't faithfully represent what's going on. It's not truthful. It's not factual. Got it? Was your question the relevance versus faithful representation?
no.
Who asked me that question? Somebody didn't hear. No, it was a principal student. Wow. She's going to be a superstar. That's right, it was. She already asked me about that. You didn't, did you, when you were in principal? She'll run a search for you can work for or something. I can't remember who it was, but I'll let you know whenever. Yeah, okay, anyway.
I'll tell you
Okay,
what.
she's going to be your boss.
Yeah, I'll tell you when I'm working for.
Yeah, okay. Yeah, that's right. You remember so-and-so? Yeah. She was a year behind me. Okay, anyway. Or half a year behind me. Anyway, what's the deal with relevance and faithful representation? Think about, no, it was you. It was fair value question. Wasn't that your question?
I did fair value versus
Yeah, and I answered with this, part of it. Fair value, you'll remember this. Fair value. Fair value versus cost. Let's use those two as an example. What's your, okay, fair value versus cost. What's the deal?
everybody have fair value, but not everybody.
What would be better to have in a balance sheet for the land of a company? Fair value or cost? Fair value, if you knew it, right? What do we do with available for sale securities and trading securities? We record them at fair market value. Why? Because we know what fair market value is. Why don't we record land at fair market value? We don't know what it is unless we sell it. There's measurement issues, measurement problems. Does that make sense, everybody? So do we sometimes do trade-offs between relevance, right, and faithful representation? Yeah. Imagine if it's an appraisal, right, that we're using fair value, appraisal on a piece of land. How do you get completeness, neutrality, free from error? Nothing. Okay. How about though if I'm using a listed stock price for publicly traded stocks? I get all of them, and I have more relevance. Got it? So it's a win-win, isn't it, in those situations? So we trade that off a lot. Okay. So nice example. What's verifiability falls into this too a little bit. You got verifiability. What's that?
Usually make sure it's the right numbers.
The independent measurers, right? Independent people, like we said, making the same estimate or valuing the same thing, looking at the same invoice. Yeah. We get what? The same answer. Okay, so it's verifiable. Okay? Verifiability is a component of what? Both. If it's not verifiable, it's not relevant. It's not verifiable, it's certainly not faithful representation. So that's the way to view this. What about comparability and consistency? They only use comparability. It really means both. Comparable means you can compare across what? Companies between companies. Comparable is company to company. That's all you got to say. Right? I can make comparisons between companies. So we use the same generally accepted accounting principles across companies, at least within the same industry. Right? And in general, across all companies, but there might be specific generally accepted accounting principles within industry. Okay, within an industry. Okay? So yeah, so that's comparability. What's consistent? Consistent, yeah, same method over time, period to period. That's it. Consistent is period to period, comparability is between companies. Got it? Okay? Really critical that you know those. Okay? I'll quiz on that stuff too. All right? And then what else do you need to have? Timeliness. If you don't get, you know what? I can tell you what Walmart stock February 28th, 2016. I can tell you. Would you like to know that? Okay. You know what? If we knew that right now, we could place bets and capture a tremendous amount of wealth. Because we know if it was going to go up or down, and even how much, we could place bets. Futures market. And we would win, because we know that nobody else does. But bad news for you, though. I can't tell you until February 20th. At the close of business, I'd be happy to. How much money can you make with that information? None. Yeah, same as everybody else. You might be able to make a decision to buy or sell as part of your decision, right? You know, but doesn't, you know, can't place any bets on that. It's too late, right? Timeliness. So what if you get the information? Balance sheet, income statement, cash flow statement. Months after the activity happened. So, too late. I think bankrupt by that. Timeliness. You got to get the information time you need to make decisions. Otherwise, that information is no longer relevant. It's not a faithful representation of what's going on now anyway. Right? So it applies to all. And then understandability game. You can't understand the information. It's not particularly useful. Which, by the way, we write lots of notes to the financial statements. Financial statements are really, really long, I think. We write lots of notes to financial statements. I'll tell you what. They're really hard to read a lot of times. And then I think about understandability, really. How many of you guys are pretty good writers? You know, pretty good in English, right? Yeah, that's a wonderful skill to have. Don't let anybody know that when you go to work, because they'll make you write everything. Not how you want to let them know. They will have you write numbers and stuff, right? Make them understand. If you have to use a lot of big words when you're writing, you don't know what you're talking about. I'm sorry. You ever read something where you only understand about half the words because they use so much technical jargon? Who are they talking to? Right? I have a guy, a brilliant fellow here. He got one of the high scores in the nation on all four parts of the CPA test when he left. And we put a billboard with him out by the freeway. This is picture up. We have all kinds of people pass the CPA exam. So lucky. Yeah. Now I can't remember his name. Isn't that good? Anyway, he's working for PricewaterhouseCoopers. He's a real nice kid. But anyway, in spite of it. Anyway, he was in the MBA program. And I'm in the class. And he's presenting a paper to us. You know, to do some research. Nothing really I have to do. He's doing this. And I stopped him after about 5 minutes. He had a half hour or something to present. And I said, you know, I wish I could remember his name and see his face. Anyway, I said, you know, who are you talking to? He says, huh? Talking to all the people, see? And you. And I said, how many of us do you think understand what you're talking about? These were people with marketing degrees, right? Finance degrees, education degrees. Yeah, that's an MBA program, right? Very few people have an accounting degree, right? How many of you guys know what he's talking about? May have research. None. So you're making a presentation to me, huh? That's going to work really well with your clients. Go into your client's office and use terminology way over the top of their head and have them not know what the hell you're talking about. How long are they going to keep you on as their CPA? You're going to be brilliant. They're going to put you in a closet somewhere, having you technical stuff, and never let you talk to you. Fine if you're in a meeting with partners and they're all experts on the thing, right? The staff, they're all experts. Be careful with that kind of stuff. So when you write an essay for me, I don't want big fancy words. I want you to tell me what you know. By the way, do you use technical terms that are in the book? Sure. Because I know what they are, right? And on a test, you're going to assume I know. Think about the audience. Right? Think about that. When you're talking to your clients, for heaven's sakes, don't use technical jargon. But they hire you for, right? And if you do, and they get a puzzled look on their face, explain, right? What do we need to do here? Where are we at? I hate those. What do you call that? Acronyms or something when you use just the letters of the title, you know? You guys know what FINRA is? FINRA. Everybody that I'm working with now in this nonprofit I'm working on knows what FINRA is, but they don't know what it stands for. It's just FINRA. I had to go look it up, and I can't remember either. It's a big, long name, but they call it FINRA. Be careful with that kind of thing, right? What if I sent you an email and I said, well, we're going to FINRA. You want to join us? Yeah. Look that one up.
Get back to you on that one.
Yeah, that's right. Let me do a little research first, yeah. Okay, the basic elements. Now the elements are on the other side, right, you guys? If we go to that pyramid, back on page 44, we had qualitative characteristics, now we got elements. So objectives, by the way, the pyramid's upside down. Think of it as being upside down. I don't know why it is, but that's the way it is in the conceptual framework. If you look on page 44, that should be tipped up the other way. Objectives first, right? That's the first level. Then qualitative characteristics and elements, and then the third level, the how implementation. So I don't know why they put it upside down, but it is.
Okay, so when we're doing the relevance based representation, do you want to put like for the definition like fundamental qualities and then explain relevance?
That would be cool. It doesn't have to be everything, you know what I mean? Yeah. But it shows some intelligence. Let's do a scratch. Not Isn't it a confidence building to come here every day? Yeah. Imagine if it worked for me. We'd have a really good time. People like to work for me. You know why? Because we got a lot done. I demanded a lot of me, them. We got a lot done, and I argued really strongly for their raise. No. The staff members then working for me. They were working way too hard for that puny little raise. I don't want to believe you get any better than that. Hard. Really? Yeah. You got to get more than that. What is it? So, yeah. Staff like me a lot. Okay, could you give me the definition of assets, liabilities, equity, investments, owners, and so on? Those are the elements. Okay, great. We know what these things are. But do this for me. Okay? So kind of memorize them. Okay? But what's the difference between a revenue and a gain? They kind of go together. They're both on the income statement. What's the big difference? Huh?
You had this on your answers.
I had them answer.
On that you posted on Moodle.
Oh, good. Okay, yeah. So what is it? What's a revenue? Let's look at the definition of revenue.
Wait, a revenue is from central operations.
Oh, a revenue is from central operations, and what you're in business to do.
Yeah.
I am Ford Motor Company, so when I sell Ford trucks, that's revenue, right? So what would be a gain?
Is anything
Peripheral or incidental, yeah, peripheral. Isn't that a great word? Peripheral, right? It's peripheral to the business. So if I'm Ford Motor Company and I sell a desk, the piece of equipment I've got, I'm not in business selling desks, I'm Ford, right? So what is that to do? That'd be a gain or a loss transaction, right? Peripheral, non-operating, right? Peripheral to the business. How about if I'm UPS and I sell a Ford truck? That's a gain or a loss, right? Because it's peripheral. What if I'm UPS and I deliver freight? Deliver packages? That's revenue. That's all it is, you guys. Okay, that's the big distinction. And obviously a gain, you have a profit. A loss, you have a loss of a deal, right? Okay, it's negative. All right? By the way, with revenues, you have to have expenses, right? With gains and losses, right? With gains and losses, you don't. Okay, so let's read these. When you're looking at them, read them really, really carefully. It'll pay off big time. Okay? Don't just read it and don't just memorize it. out of context, because you'll never remember it, okay? But let's do assets first. Probable, if it's for sure, there's no such thing. My God, look at that. In my wallet. Thanks, Mom. Oh, I mean, Laura. Yeah, anyway, I get an allowance. I don't know how often I get it, but every once in a while, $20 shows up in my wallet, and then it disappears. I don't usually take it out, but it disappears. So she puts it in and takes it out, puts it in. I have a bank. Okay, anyway, yeah. Piggy bank. So, no, that's right. I have to buy beer for tomorrow night. I have a beer with Frank Raymond's going to be sabbatical this semester, so we're going to have a beer at his house next hour and watch something. So, okay, here we go. This is not for certain an asset. Why not? Typically, cash is not as certain as you can get. It may have no economic value. Why? It could be counterfeit. Nothing is certain. Nothing is certain. So it's probable. It's a probable future economic benefit. Your intermediate book, well, in his case, it's probably not probable. But is this a probable economic benefit or not? Yeah, I hope so, right? So it's an asset. What if you weren't going to read it? I guess it's not an asset. Well, it's a liability, maybe, yeah. Because it's painful, yeah, carrying it around. Okay, you got the idea? It's got to be probable. Future, if it already happened, what is it? You got the benefit already, what is it? It's a revenue, right? Of course. So it's got to be future. Economic benefit, if there's no economic benefit, that's what we're majoring. So it's got to be an economic benefit, which really means cash in the future, right? Okay, in some fashion. Okay? Obtained or controlled by a particular entity. You know what? That's her book. That's her book. You don't own hers and she doesn't own yours. It's got to be yours. Yeah? Obtained or controlled by a particular entity as a result of past transactions. You know, I haven't bought the book yet. I don't have an asset yet. It's got to be a past transaction or event, right? It could be that I produce the asset or something. You know what that just defined? Your possessions, your stuff. Is it things you own? No, because some of your assets you might still be paying for, right? We have a $200,000 house. We think that's about what it's worth. We own 30,000 of it. We owe 107. No, we own less than that. We own 20. We owe 180. Can you believe I'm 65 years old and I don't own my house? It's a puny little house over here in the Highlands. That's a total abject failure, right? You know how much my mortgage expense is? You know how much the interest is on my mortgage? 3%. You know how much I make in the stock market on average every year of my life I've been investing? 12. Maybe it's 11 for the last, no, it's not 12. It's about 12. It was getting up to 13. Everybody said, oh, well, the world's changed. Yeah. Okay, so it's about 12, right? Okay. Do you guys know that the stock market went down to 6,500 or something when it was at 13,000? Cut in half. You know what it is now? 7 years later, thanks to Obama. I'm kidding. The president has nothing to do with it. Okay. But what happened? What is it now? It was 18. Now it's 16.5 or something. It's down now. And everybody says, oh, the sky is falling. Are you kidding me? The sky is falling with 6,500. Right? So, wealth's going up, guys. Things are good. Did you see the President State of the Union, anybody, or any clips from it or anything? And he said, he was talking about the economy and what's really happened in the economy. You know, 7 years ago, we thought we were going to have a depression. Now, is everything good? Of course not. I could have $100 billion. I'd be happier, right? But is the economy pretty strong? Yeah, probably as strong as it's ever been. Yeah. We're probably richer than we've ever been. We just are. That doesn't mean we can't do better, right? But we are. By the way, are a lot of people making less money than they used to? Yes. Yes, wages are depressed. Not in the job categories you're going to. Those are gone. Yeah. Rich are getting richer. You can join the rich. You rock. Yeah. Upper middle class is where you're going to be. Sorry. I feel really bad that I'm helping you turn into horrible people in that category. Okay, anyway. What's different with liabilities? Still probable, still future, but now it's a sacrifice. Still economic benefits,
present obligations of a particular entity sounds the same, doesn't it? To transfer assets or provide services. Okay, how do you remember this? Transfer assets, I pay with cash, right? A liability. What is future or provide services? What's that?
Unearned revenue, yes.
That's it. You know about unearned revenue, don't you? I'm not going to pay for it with cash. I'm going to pay for it by doing the work. That I promise. Easy to remember. Because you already know this. You already know these definitions. You just haven't been using these words. And if you go through every single one of them, it's like that. Okay? Equity is the residual interest. Don't say equity is assets less liability from market wrong, even though that's exactly what they say here. Residual interest in the assets of an entity that remain after deducting its liabilities. It's the ownership interest. That sounds good. Something like that. Okay? You don't have to use exactly those words. Investments by owners, bring something of value in, right? Okay? But it could be all sorts of things, huh? Increase in net assets of a particular enterprise or results from transfers to it from other entities of something of value in order to obtain or increase ownership interest or equity in it. Assets are most commonly received as investments, but that which is received may also include services or satisfaction conversion of liabilities.
Can you imagine a situation when you credit common stock, credit contributed capital of some kind, right? And you debit cash or equipment or building or legislature. Can you think of a transaction where somebody owes you money and they don't have the money to pay you, so they give you stock for it? And you debit notes payable and you credit common stock? That's the liability one. Got it? Can you imagine a transaction where I'm forming a corporation and I want to hire an attorney to help me set up the corporation, but I don't have any money? So I give them a few shares of stock to do it. They own a small portion of the company. And I debit organization costs or legal fees expense. One would be an asset, one would be expense. Debit one of those, and I credit common stock. Wow. Getting the idea how this might work? Okay, services. Okay, so if you think of the journal entries, you'll have the definition. No, won't have those exact stuff. Distributions to owners, what's that? Dividends, right? Okay, or maybe buying back stock. Okay? The decrease in the net assets. By the way, what does net assets mean? It's assets less liabilities. Either giving up assets, right, or incurring liabilities. Right, guys? Okay. Think about a dividend. You declare it. What do? Debit dividends or retained earnings, right? Retained earnings. And credit what? What? That's only if you gave it to them. That's if you declared it and paid it at the same time. What did you just declare? A liability named dividends payable. So I'm incurring a liability as I'm doing a distribution, right? Debit dividends or retained earnings and credit dividends payable, right? Everybody agree to that? That could happen. Or if you give them the asset, debit the dividend and credit cash. And that's all it says. Big deal. Okay? So that's distributions. Okay. What's this? So revenues, let's skip comprehensive income for a second. Revenues are inflows or other enhancements of assets of an entity or settlements of its liabilities or a combination of both during a period from delivering or producing goods, rendering services or other activities, and what's the biggest thing? Constitute the entity's ongoing major or central operations. So it's an inflow of assets or a settlement of liabilities. Huh? I earn revenue when I debit unearned revenue and credit revenue. That's all that's saying. Right? Okay. And I can certainly debit cash or accounts receivable and credit revenues. Everybody agree with that? Okay. Expenses, just the opposite. Instead of an inflow, it's an outflow, or other using up of assets. Remember, assets getting prepaid insurance. When you use it up, it becomes prepaid. It becomes insurance expense. Debit, prepaid, debit, insurance expense, credit to prepaid. Right, guys? By the way, are all of you keeping up with me? Remembering principles when you couldn't? How fast can you listen now? How fast can you think now? Cool, huh? We can get a lot done. Okay, we will, right? When you go to work, you will too. Boom, boom, boom. Besides, the day goes much faster if you're really involved, you're really thinking. You're tired of it, but they have bourbon for that. It'll be fine. Okay? Yeah. Fine, beer, whatever. Don't do drugs, though. I love that. Don't do drugs. What a society. Okay. Stay away from those drugs. Caffeine sitting there. Okay. Anyway. All right. So, anyway, it's an outflow.
Incurrence of a liability, debit expense, credit liability, debit salaries payable, credit, debit salary expense, credit salaries payable, sure, or using of an asset, I already did that one, didn't I? Debit supplies expense, credit supplies inventory, these are too easy, I think. But it's from what? Delivering or producing the goods, rendering services, carrying out other activities that constitute the entity's major ongoing activities, right? What do we do for gain? Instead of saying increase in assets or decrease in liabilities, they say net assets, fine, that's increase in equity. Peripheral or incidental, like it? Except for those resulting from what? Revenues and investments by owners, huh? How can you increase equity? Contribution from the owners, revenues, and gains. So it's everything else except for revenues and contribution from owners. Easy definition. Okay? So, did you think about it this way when you were reading them? A little bit, maybe. Get that way for everything you do. Okay? Everything you're reading, tear it apart. Read it once, read it carefully, think about it, right? And move on with your life. Add it to your set of tools. How many of you did a brain dump after 101? It's been so long since I taught you 101, right? Or maybe a long time since you had 101, right? But how many of you just, all this stuff is kind of feeling foreign? You know what that is? You didn't really absorb it and learn it and keep it. And everybody does this, right? Everybody does this. You need to break the habit. Why learn something more than once? It's painful to learn things, isn't it? This is work. Learn it, keep it. Learn something else, add it to what you know, integrate it, and keep it. Keep going, keep going, keep going. This is a huge, if you get those CPA review manuals, she's going to learn it for the rest of your well. Everybody should. On the syllabus it says you have CPA review manuals, get them, right? And be strong for it, okay? Get those CPA review manuals. Take a look at the diagnostic exam for the full exam, for the full CPA exam. You're like, there's no hell I can know this 2 years from now. Or you're going to have it. Yes, you can. Yes, you can. Okay? So, keep it as you go. Keep it as you go. Anyway, loss is just what? Reduction? Decreases in the net assets from the same stuff. Big deal. Except instead of revenues or investments from owners, what do we exclude? Expenses and distributions. The distribution could be buying, trading, and stock. We don't say what. No. So, they're buying back the stock. All right, enough of that. I'm tired of it. Okay, how about these assumptions that I'm not going to get to? Of course not. Economic unity assumption? What's that?
Separate the others from the business.
Yeah, separate the others from the business. Okay, good. Okay. Going concern assumption?
So business is always in business.
They're going to stay in the business in perpetuity, right? In practical sense, when we do auditing, you're going to guess whether or not it's going to last for a year. We take out the crystal ball and guess whether they're going to make it for another year. If so, they're a going concern. If not, they're not. And guess what? If they're not going to make it for another year, what do you have to do? Record everything at liquidation value. Their assets now are worth almost nothing, right? And usually negative debt, equity by then. They're going broke anyway. They probably already paid with equity, right? Their assets exceed, or I'm sorry, their liabilities exceed their assets. But it's far worse if it's a liquidation value. Okay, so we make the assumption that it's a going concern. And we separate the owners from the entity so we can tell what the entity is doing. Monetary assumption, monetary unit. Why don't we call it the dollar assumption? Because, there's euros and yen and other types of currency, right? So we call it the monetary unit assumption. We assume that measurement is in monetary units. It's money, right? Everything's that way. Cash is cash, but equipment's measured in terms of cash too, right? In terms of dollars in our case. Okay, that's all that's talking about, monetary unit. Okay? And it's really, really important because in Latin America where they have lots of inflation, and other countries when their economies get in trouble with lots of inflation, we have before in our history too, had quite a bit. Everybody starts talking about doing price level adjusted statements. If you have 20% inflation in a year, 1 year really isn't the same as the next year. Purchasing power changes. So then we do inflation adjusted statements. So that gets to be a really big topic, and then we get inflation back under control and nobody cares anymore. It goes away. So we don't do inflation adjusted statements, but we could. Periodicity or periodicity, I guess it's periodicity. Periodicity, what's that?
The more periods you have, the less accurate the info is.
Well, that's true. That is true. The more you do, the less accurate it's probably going to be. But so we do split it into arbitrary periods of what? 1 year. And we do quarters, we do months within that. But it's arbitrary.
You might, a construction company, the company's doing those bridges downtown. Is their project 1 year? Of course not. But they'll do accounting year after year after year. So they have to use something called percent of completion accounting for jobs that don't get done. They're huge within a year. Okay? McDonald's doesn't have to do that. Why? Because it's turning fast, right? How long does it take to, produce whatever they produce, that stuff they call food? They produce it and they send it out, right? Okay? I still go to McDonald's because their bathrooms are really clean when my wife and I travel. So we stop in there and we buy water. I don't think they can screw that up, can they? We buy it in a bottle. Right? Well, that way they get money. That way they get money, yeah. Or we're using the bathrooms. Anything is fair?
Yeah.
They have absolutely nothing on their menu that you should eat. It's ridiculous.
We've ever been Mocha, man, and Mocha's actually pretty good.
It's 100% sugar.
Exactly.
Read the ingredients. Just like Starbucks is, so I'm not going to be too critical because I do go to Starbucks. But I like theirs better because they have more coffee.
So you're paying extra money to go to,
They have clean bathrooms too, leave me alone.
Starbucks has a great.
Yeah.
Yeah.
I never go to these places unless I travel. I feel bad because I never go to Iron Brothers. It's a great business, and their coffee's fine. I like it. But my coffee at home is better. It's so much stronger. So, yeah. Oh my.
Have you ever had Deathwish coffee?
There?
No, like you should look it up and buy some.
Oh, really? Or it's a type of coffee?
It's
Yeah.
a brand of Deathwish.
Oh.
It's called Deathwish.
Deathwish.
Makes me either.
Oh, that sounds good. Yeah.
She wants to do.
I'm that way with Herman too. I don't drink. I talk like I drink all the time, but I don't drink really very much. But when I do drink, like that guy, the good-looking guy that's always with the women, the old guy. Yeah, Dos Equis.
Oh, the most
Yeah.
interesting man.
Most interesting man in the world. It's kind of like that. I don't drink very much, but when I do drink, I like.
I don't drink, but when I
150
do
proof
drink,
stuff,
I am the most
so.
interested.
So you can feel it.
Nespresso.
What's that?
It's called Nespresso.
Nespresso?
Yeah, they only, my family lives in Europe, and they only have it there,
Yeah.
and we can only buy the cups in Europe, and that's like, when I went there and had it, it was the best
Yeah.
coffee.
I like going to Europe and just having little shots of espresso.
That's what they have,
Yes.
it's tiny little, that's what each.
And they're everywhere. It's a euro. Wherever you go, it's a euro, right? Because it's still, maybe it's more.
It's potentially
It's
good.
pretty cheap. Yeah, it's pretty cheap. But it's a little tiny thing. So every hour on the hour, you're in a
It's like a
different
beer.
place traveling around. Yeah. I was a little wired. You had to go for 20 hours. So. Okay, anyway. So, gosh, we're waiting. So anyway, we split it. That's all right. You guys have read this, right? You're studying it. You know what you're looking at. Okay, good. Yes, sir. Okay, measurement principle. We talked about historical cost. We like it because it's verifiable, huh? And then fair value, we like it because it's probably more relevant. Okay? There is the fair value option. The board is taking the additional step on page 57. The board is taking the additional step of giving companies the option to use fair value as a basis for measurement of statements. Once you do that, though, you have to do it forever. Right? You adopt it, right? Most companies have not done that. And prices change so much. Imagine when the stock market went from 13,000 to 6,500. How many people were in a lost position on their stock portfolios? So then everybody says, I hate fair value. As the market's going up, everybody loves fair value. Well, yeah, you don't get the upside, the gains, and not take the downside too. So would this be problematic if we went to fair value for everything? Measurement issues, and then fluctuation in the stock, not fluctuation in the stock fluctuation in the asset values. By the way, fluctuation in your earnings is how we are going to measure risk as a company. It's going to be the proxy for risk. So people don't like fluctuation in their earnings. That'll make sense when we do weighted average cost of capital, asset pricing model. So yeah, I think this illustration 2.4 is kind of neat. All these things. There's a lot of stuff in here. Oh, by the way, always read the footnotes. See all those footnotes at the bottom of page 57? Always read that stuff. There's a reason they put it in there. Actually, it should be in every chapter. But I guess some people like to skip things, so, right? So read it. Okay, you have a real advantage. It also gives you better understanding. Okay, read that stuff. All right, anyway, the fair value hierarchy, this is pretty good. Least subjective to the most subjective. Published data, on stock prices for publicly traded companies is level 1. That's really good, huh? And then it goes all the way down to unobservable inputs, the company's own data or assumptions. That's, how would you audit that? It's so subjective that maybe that's not very,
useful.
It's not very useful because it's not a faithful representation. It is still relevant. All these are relevant, but that's not a faithful representation versus level 1 is. And then level 2 is just stuff in between, right? Okay, so it makes a good point. Makes a good point. Okay, and what we'll do, you want to take a few more minutes?
Yeah.
We're doing pretty good. It's probably worth talking about. If you have some place, you got to be at 10 till, okay? Otherwise, we'll go for a few more minutes. I don't have my other class till 1:30 anyway. Revenue recognition principle. And there's an expense recognition, which used to be called matching, but it's still matching, even mentioned matching. What's revenue recognition?
You recognize the revenue whenever you do the service or provide the product.
Okay, when I provide the goods or services to the customer, I recognize the revenue. But there's more than that. That is when I do it. That's the timing of it. Joe really energized.
The whole 40 count.
So what do you think? What else is required? Okay. It is really important that my customer is going to pay me. It is probable, it's never certain, right? It's not an asset unless it's probable. Probable future economic benefit. I don't have a receivable unless they're going to pay me. So I need to have delivered the goods and services, and I have either realized, that's the term we use, right? I've either realized, what does that mean? They gave me the cash. Realization is cash. Recognition, remember, from principles is I earned it, I recorded the revenue. So I would debit accounts receivable and credit sales, or I would debit cash and credit sales, typically, right? Okay, see, if I am going to debit cash and credit sales, obviously I realize that they paid me. So I can do that. It's okay. If I deliver the goods and services, the earnings process is substantially complete. That sound good? Okay. How about, though, if they're going to pay me later? I debit accounts receivable and I credit sales, don't I? But I would only do that if what? That account receivable is realizable, right? In other words, they're going to pay me in the future. It's probable they're going to do that, or it's not an asset. Got it? So, for something to be realizable, what do I have to have? They have to have both the ability to pay me, right? They're not bankrupt, right? They have the ability to pay me, and they intend to pay me. Double. What if they're a thief? They might be rich, but they're a thief. I'm still not going to collect. Or what if they're really a nice person and they have high integrity, but they're bankrupt? They're not going to pay me. The issue is whether or not they're going to pay me. Got it? So all of that is wrapped up in this revenue recognition principle. Okay? What's expense recognition? As I consume assets or incur liabilities, right? Incurring costs. The costs are the expenses, right? We call them expenses. In incurring costs that are going to generate revenues. Now, they don't have to generate revenues. We intend to generate revenues. What if I run an ad campaign? Debit advertising expense and credit cash or accounts payable or whatever, right? I have the expense. Might I never get any sales out of that ad campaign? Yeah. But you're attempting to. So like when they hire you, you know, and you go to work, still debit wage expense and credit cash even though you did nothing, right? Gotcha. Okay. So, good example. All right. Anyway. All right. So, expense recognition principle. Used to call it the matching principle. See down there at the bottom, page 59?
Yep.
Often we call it the matching principle. When you go to work, everybody still calls it the matching principle. And it makes sense. If I recognize the revenue this period, I should recognize all the expenses incurred to generate that revenue. If I got the revenue this period, all the costs associated with earning that, right, are expenses for this period. Make sense? Matching principle, which is also the expense recognition principle. Get them matched up. Okay? That sound good? This is easy, isn't it? Okay, and so the 5 steps of revenue recognition: identify the contract with the customer, identify the separate performance obligations in the contract, determine the transaction price, allocate the transaction price to separate performance obligations. And then recognize the revenue when each performance obligation is satisfied. This is international financial reporting standards, which are being converged. You read about a little bit now, right? With U.S. GAAP. Converge means we don't want to adopt theirs. They don't want to adopt ours. We're converging, right? Both are moving. So painful on both sides.
hard to get agreement. What's the full disclosure principle?
Disclosure.
Disclose everything that is what? Material, everything that is what? Relevant? Yeah, the relevance is everything that's useful for making a decision. It's decision usefulness, isn't it? Right? So disclose everything somebody needs to make decisions. Would you ever disclose anything? Oh, yeah, it's not for somebody who doesn't know anything about business, anything about accounting, doesn't know anything about anything, never read a financial statement. It's not that. It's what? A reasonably informed financial statement user, right? An intelligent person who's trying. That's basically it, right? They're trying. And they'll hire professionals to explain the stuff to them, right? Okay? So, it's all right. Let's see. I guess you get no product cost and period cost. That's easy. You remember that 102?
Yeah.
Product cost, materials, labor, overhead. That's all that is. Period costs, everything else running the business. Knowing that distinction is good. Oh, the notes to the financial statements, an integral part of the financial statements. We say at the bottom of the statement, the little parentheses, the accompanying notes are an integral part. So that's part of the full disclosure. Okay, obviously, I guess. Supplemental information might be separate schedules that are also part of the statements, really. Cost constraint, we talked about cost benefit, okay? Wow, if you knew everything on page 62, and you could talk about it intelligently, you would have it made for this quiz. The whole world there. Not much. Okay. We happy? I'm tired of you people. I was tired before you got here.
Yeah. That's why you're drinking the 40 calories.
That's right. Need the boost. This is fun stuff, huh? In chapter 3, we will get back to number. Big time. And if you
Oh.